This is the most dangerous moment you will ever face in the silver market. I need you to stop looking at the price chart. I need you to stop obsessing over the red and green candles flashing on your phone screen. I need you to stop refreshing Kitco, wondering if silver is going to bounce back or crash lower. Because I am telling you right now, with absolute certainty, that the price on the screen is becoming irrelevant. The number you are staring at, $77.69 per ounce, as of today, Saturday, February 7th, 2026, is a ghost. It is an echo of a system that is dying in real time. What matters right now, what determines whether you have wealth or whether you have nothing, whether you're solvent or whether you are bankrupt, is not the price. It is the infrastructure of the market itself. It is the plumbing. It is the gears. It is the unspoken agreement that allows trade to happen. And according to the latest data published by COMEX itself, that infrastructure is about to snap. The plumbing is about to burst. The gears are about to grind to a halt. We are looking at a mathematical countdown to a delivery crisis that will reshape the precious metals market for a generation. For years, we have been warning you. We warned you about vault depletion. We warned you about the growing mismatch between paper contracts and physical metal. We warned you about industrial demand explosion. But what is happening now is not theoretical. It is not a forecast. It is a publicly visible countdown to a moment where the exchange must either deliver metal it does not have, or admit that the paper market has been running on fumes. We have just analyzed the latest inventory reports from COMEX, and the numbers reveal a crisis that cannot be hidden anymore. This is not a shortage. A shortage implies the market is working, but supply is tight. What is happening is a system failure. It is a total collapse of the mechanism that supports the entire Western precious metals industry. The world's largest silver exchange, COMEX, currently has 103 million ounces of registered silver available for delivery right now. That is the official number, 103 million ounces. That is the metal that can actually be handed over when a contract holder demands physical delivery. Now let me show you the other side of the equation. COMEX is facing over 400 million ounces of open contracts. 400 million ounces in contractual promises. 103 million ounces in actual deliverable metal. It is like having 100 pizzas and 400 very hungry people showing up for dinner. The first 100 people eat. The next 300 get excuses, apologies, and maybe cash instead of food. Now, for those of you who do not understand how the COMEX system works, let me explain the architecture, because this is where the entire deception is built. COMEX is the commodity exchange. It is where silver and gold futures are traded. It is technically part of the CME Group, which is the Chicago Mercantile Exchange. It is the official price-setting mechanism for all precious metals in America and largely the world. COMEX is what Wall Street calls a paper market. Most people trading there never touch physical silver. They are allergic to the actual metal. They are trading contracts, promises, and those promises are settled for profit in cash, not in metal. It is like walking into a restaurant where 95% of people are just exchanging pictures of food and then going home. They never consume the actual meal. They never even see the kitchen. But COMEX operates with two distinct categories of inventory, and understanding this distinction is absolutely critical. First, there is registered silver. This is silver that is available for delivery. It can leave the vault. This is the metal that, when somebody says, "Give me my silver," COMEX will hand it over. Second, there's eligible silver. This is silver sitting in COMEX vaults, but it belongs to somebody else. It is not available for delivery unless the owner wants to move it or sell it. Eligible silver is like your neighbor parking his car in your garage. Yes, there is a car sitting there, taking up space, but it is not your car. You cannot give it away. You cannot sell it. It just sits there. When COMEX publishes their official inventory reports, they love to combine both numbers. They report total inventory, which includes both registered and eligible. This makes the vault look much fuller than it actually is. It is like you saying you have 12 parking spaces with 12 cars, but 11 of those cars belong to other people and only one is actually yours. COMEX does this constantly. And as of February 2026, COMEX has about 103 million ounces of registered silver. That is the number that matters. Total inventory is over 400 million, but that number is completely irrelevant because the vast majority of it is not theirs to deliver. It is noise. It is a number designed to create the illusion of abundance when the reality is scarcity. Here's where the situation becomes absolutely urgent. Registered silver, the actual deliverable metal, is down 70% since 2020. 70%. The real inventory has collapsed, and the bleeding is accelerating. COMEX vaults are losing 785,000 ounces of silver every single day. 785,000 ounces marching out the door every 24 hours, never to return. If you think about this for a moment, the scale of the drain becomes clear. We had over 300 million ounces of registered silver in 2020. Now we have 103 million, almost a million ounces per day walking out. How long do you think the system can sustain that kind of hemorrhage? Let me give you a simple framework to understand what is happening and what is about to happen in the next 20 days. I call it the vault pressure position framework. First, we verify what is actually in the vault, not the headline numbers, not the total inventory fiction, the real number. Then we understand the pressure that is building as contracts convert into delivery demands. Then we position ourselves accordingly before the system breaks. Let's start with vault verification. We have already established that registered silver stands at 103.5 million ounces as of this recording. But that metal is not sitting in one centralized location. COMEX vaults are spread across multiple facilities managed by different banks and different depositories, and the number changes every single day. In January of 2026, almost 50 million ounces left those vaults. 50 million ounces in a single month. Why is that number so staggering? Because if you rewind the clock just 2 years to 2024, when the world was still blissfully unaware of the silver supply crisis, only 6.8 million ounces left the vaults in an entire year. Let that sink in. We have gone from 6.8 million ounces leaving annually to 50 million ounces leaving in 1 month. This is a 7 times increase in the drain rate. The official explanation from the exchanges is that this is normal market activity. Sure, 7 times more deliveries is normal. It is like your credit card bill being 7 times higher than usual and your bank calling it normal spending. But dig a little deeper and you realize this is not just a COMEX problem. This is not isolated to America or New York or Chicago. Shanghai silver inventories are at their lowest level since 2016. The London Metal Exchange, where some of the biggest players in the world trade, is at historic lows. It is like a global game of musical chairs, and the music is getting quieter by the day. Meanwhile, China has classified silver as a strategic material and implemented export controls. You cannot just ship the metal out of China anymore. And China is one of the biggest silver processors on the planet. The United States has also classified silver as a strategic material. We are not talking about conspiracy theories here. We are talking about official public government policy. Now, there's one indicator that tells you, with brutal honesty, whether there is plenty of silver in the system or whether the market is desperately short. Most people never hear about this number. It is called the silver lease rate. The lease rate is what it costs to borrow physical silver. Why would someone want to borrow silver? Say you are a Wall Street trader and you want to short silver. You think the price is going down. To short silver, you need to borrow physical metal first. To borrow that metal, you need to pay an interest rate to whoever owns it. This is the same mechanism that happens when brokers lend out your shares. You might have noticed when you open a new brokerage account, there's an automated setting that says share lending is enabled. Earn money with share lending. It is turned on by default. What that means is your broker is lending your assets out to someone else. If that someone else goes bankrupt, what you lent them is gone. It vanished. But back to the lease rate. Normally it costs less than half a percentage point to borrow silver, less than 0.5%. Why? Because silver is plentiful in the system. Right now, the silver lease rate is 8%. 8%. That is 25 times higher than normal. When lease rates spike like this, it means physical silver is extremely hard to find. People are willing to pay outrageous interest rates just to borrow the metal. This does not happen when vaults are full. It happens when vaults are empty and traders are scrambling. But COMEX says everything is fine, just business as usual, just normal market dynamics. Maybe they borrowed the phrase seasonal adjustments from the government, which uses it to manufacture fake economic data. But something about this official narrative raises massive red flags. Now we move to the second part of our framework, pressure. March is a major delivery month for silver on COMEX. What does that mean? It means contract holders who own paper silver can demand physical silver in exchange for their contracts. And the numbers are absolutely staggering. There are contracts representing approximately 500 million ounces of silver sitting in the system right now. There is 100 million ounces of registered silver available to deliver. How is that even possible? How is that legal? How can you promise 5 times more metal than you actually have? But that is exactly what is happening. Think about the math for a moment. If just 10% of contract holders decide they want physical silver instead of a cash payout, that is 53 million ounces demanding delivery. The vaults currently hold 103 million. Half the inventory would vanish. What if 20% of contract holders stand for delivery? That is over 100 million ounces. The vaults would be completely empty. You could host dinner parties in those warehouses, but they would be otherwise useless. The first day we are going to find out what is really happening is February 27th. Write this date down. Circle it on your calendar. February 27th, 2026. That is the first notice day for March delivery contracts. That is the day when traders must officially declare whether they want physical silver delivered or whether they will accept cash settlement. And between now and that date, the bleeding continues. 785,000 ounces per day walking out the door. If you do the math, between today, February 7th, and February 27th, another 16 million ounces will likely leave the vaults. The inventory will drop from 103 million to possibly 87 million before first notice day even arrives. Now here's another piece of data that is absolutely terrifying. In February 2026, the delivery rate is currently 98%. 98%. What does that mean? It means 98% of people who have the option to demand physical delivery are taking it. They are converting paper into metal. Over 18 million ounces have already been delivered so far this month, and we are only a week into February. This is not a bunch of retail silver believers stacking coins in their basement. These are institutional traders. These are hedge funds. These are sophisticated players who understand exactly what is happening. What they see is an opportunity. They can buy paper silver at the current suppressed market price, and then they can demand physical delivery and receive actual metal. Why is this happening? Because when you go to a silver dealer right now and try to buy physical metal, they tell you it will be delivered in June or July, 6 months from now. There is no metal available today. So if you are a trader with capital and you want silver immediately, you buy the futures contract on COMEX and you stand for delivery. You get the metal now instead of waiting half a year. Why are people doing this? Profit, greed, opportunity. But there is likely another group participating in this rush. Industrial users. Imagine you are Elon Musk. You are building the largest chip manufacturing facility in the world. You're going to need massive quantities of silver to build robots, semiconductors, electronics, automation systems. Where do you source that silver? You can go to the miners, and they say you can have it in a year when we process the next batch of ore. You can go to wholesale dealers, and they say you can have it in 6 months at a $15 premium over spot. Or you can go to COMEX, buy futures contracts at today's price, demand delivery, and secure your supply chain immediately. Why would you not do that? Of course you would. You store the metal, you guarantee your manufacturing pipeline, you eliminate supply chain risk. So what happens when COMEX runs out of silver? What happens when the vaults hit zero and there's nothing left to deliver? COMEX has several options, and every single one of them destroys market confidence. First option. COMEX tells contract holders they are getting cash instead of metal. They have this power written directly into the exchange rules. You wanted silver, but they give you dollars. The same dollars the government can print infinitely. It is legal under their own regulations, but it obliterates their credibility as a price-setting mechanism. They are essentially admitting they are not really a silver exchange. They are just a gambling operation. A casino with silver-flavored chips. Second option. They change the rules mid-game. They raise margin requirements to force traders to liquidate their positions. They have already done this 3 or 4 times in 2026 alone. Margin hikes force leveraged traders to sell. When everyone is forced to sell at the same time, prices crash. They can also impose position limits, making it harder for large players to accumulate contracts. They can restrict delivery mechanisms. They did this exact playbook in 1980. They did it again in 2011. And they can introduce new contract types that have no connection to physical silver whatsoever. Just cash-settled paper. You make money, you get dollars. You lose money, you get fewer dollars. No metal involved at any point. COMEX could literally become a silver-free silver marketplace. The irony would be almost funny if it were not so destructive. Third option. Paper silver and physical silver prices completely decouple. We are already seeing the early stages of this. Shanghai physical silver is trading at a $40 premium over COMEX paper prices. $40. In a normal functioning market, arbitrage traders would step in immediately. They would buy the cheap paper silver in New York, convert it to physical, ship it to China, and sell it for a profit. This is called arbitrage. It is how markets stay connected. It is exactly what happened with gold at the beginning of 2025. Traders bought cheap gold futures in London, demanded physical delivery, and shipped the metal to the United States, where it sold at a premium. But arbitrage only works when you can actually get the metal. If COMEX cannot deliver, the arbitrage breaks. The markets decouple. You end up with 2 completely different prices for the same commodity. What does COMEX say about all of this? They say delivery concerns are purely theoretical. They have not run out yet, so stop asking uncomfortable questions. Classic. Let me show you the historical pattern, because markets repeat. Not exactly, but the rhythm is unmistakable. In 1980, we had an event called Silver Thursday. The Hunt brothers, 2 billionaire oil heirs from Texas, accumulated a massive position in physical silver. They were buying everything. Silver was rocketing toward $50 per ounce. The exchanges panicked. What did they do? They implemented something called Silver Rule 7. This rule limited silver trading to selling only. You could sell your silver, but you could not buy. Imagine that. Imagine your brokerage tells you that you can sell your stocks, but you cannot purchase any new positions. It sounds absurd. It sounds illegal. But they did it. It is the exact same thing Robinhood did with GameStop in 2021. The result? Silver crashed from $50 to $10, an 80% wipeout. The Hunt brothers were destroyed financially. And the exchanges? They said they were simply maintaining an orderly market. Apparently, markets are only orderly when they move in one direction, down. Then we have 2011, the margin massacre. Silver was surging after the financial crisis. People had lost faith in the banking system, and rightfully so. Silver climbed to $49 per ounce, nearly touching the Hunt brother highs from 3 decades earlier. What happened? The CME raised margin requirements 5 times in 2 weeks. 5 times. Each time they raised margins, it forced leveraged traders to sell. When everyone sells at once, you get a cascade, a crash. Silver dropped almost 50% in a matter of weeks. What is the pattern here? Silver threatens to break out. The price starts rising rapidly. The exchanges panic and change the rules. Prices collapse. Leveraged players get wiped out. We saw this exact pattern in December of 2025. We are seeing it again right now. Same playbook, same players, same outcome. But here's the critical difference. In 1980, COMEX had plenty of silver in the vaults. In 2011, the vaults were full. They could manipulate prices by changing margin rules because the underlying metal was still there. In 2026, the vaults are nearly empty. They can change the rules all they want. They can raise margins 10 times if they feel like it. But they cannot create silver that does not physically exist. You cannot margin call metal into existence. Before we talk about positioning, I need to show you the fundamental backdrop that makes this crisis mathematically inevitable. Silver has been in a supply deficit for 5 consecutive years. We are talking about a deficit of 200 million ounces per year. Since 2021, the cumulative deficit is approximately 1 billion ounces. 1 billion ounces of silver that the world consumed but did not produce. Where did it come from? It came from inventory. It came from stockpiles. It came from vaults. And now those vaults are almost empty. Why is there such a massive deficit in the silver market? The answer is simple. Demand. Specifically, industrial demand. Let's break it down. A single solar panel requires about 20 grams of silver. Solar energy installation is growing exponentially across the globe. Governments are mandating it. Corporations are adopting it. Homeowners are installing it. And every single one of those panels needs silver. Then there are electric vehicles. An EV requires 5 to 10 times more silver than a traditional gasoline car. The electronics are more complex, the wiring is more extensive, and the battery management systems all need silver. As the world transitions to electric transportation, the demand for silver is just exploding. And how about artificial intelligence? You literally can't spell AI without the metals that make it possible. Every AI server farm, every data center, and every semiconductor fabrication plant requires massive amounts of silver. It's in the circuits, the connectors, and even the cooling systems. When you add it all up, total industrial demand for silver is approximately 700 million ounces per year. And it's not slowing down, it's accelerating. So, why don't miners just dig up more silver? Well, here's the problem. 80% of silver production is actually a byproduct of mining other metals like copper, lead, and zinc. Primary silver mines, where silver is the main product, only account for about 25% of the global supply. You can't just decide to mine more silver. Even if the price of silver doubles or triples, it doesn't really matter. The economics of copper and zinc mining are what drive production decisions, not silver prices. And even if a company wanted to build a new primary silver mine, it takes years. You have to find the deposit, get permits, build infrastructure, and install equipment. From discovery to production, you're looking at 5 to 10 years, minimum. The supply side simply can't respond quickly. It's geologically constrained. Now, let's talk about the difference between physical silver and paper silver, because this distinction is about to become one of the most important concepts in the precious metals market. Paper silver includes ETFs like SLV, futures contracts on COMEX, mining stocks, and closed-end funds. The advantages of paper silver are obvious. It's very liquid. You can buy and sell instantly with the click of a button. There are no storage costs, no insurance fees, and no security concerns. No one is going to break into your house and steal your ETF shares. But what are the disadvantages? Counterparty risk. You don't actually own the metal. You own a claim on the metal. And when the system breaks, those claims can become worthless. You might demand your silver and receive cash instead. And if we enter a world where paper prices and physical prices decouple, your paper investment might say $77, while physical metal is trading at $120. Your ETF doesn't track reality anymore. It tracks a broken system. Physical silver means coins, bars, and rounds that you hold in your possession or store in a private allocated vault. If you own physical silver, there's no counterparty risk. It's yours. You control it, you possess it. But there are trade-offs. You have to store it securely. You have to insure it. You pay a premium when you buy it, and it's far less liquid than paper. You can't sell a physical bar with a mouse click. You have to find a buyer, ship the metal, verify its authenticity, and settle the payment. The official narrative from the financial industry is that paper and physical silver are equivalent, interchangeable, fungible. And that's true until it isn't. When Shanghai is paying a $40 premium for physical silver over COMEX paper prices, they're clearly not equivalent. When dealers tell you they can't deliver metal for 6 months, there's obviously a problem. The equivalence is broken down. Now, I'm not telling you that silver is going to the moon tomorrow. I'm not promising you riches. In fact, the exchanges could change the rules at any moment. They've done it before, and they'll do it again. There could be short-term crashes, brutal drawdowns, and margin hikes that force liquidation. We've seen this pattern repeat multiple times. The risk for short-term traders is very real. You could get burned badly. We've watched it happen again and again, but the opportunity exists because of one undeniable fact. The vaults are nearly empty. The supply deficit is not going away. Industrial demand isn't shrinking, it's growing. So even if the exchanges manage to paper over this crisis in the next month or two, even if they change the rules and suppress prices temporarily, the fundamental problem remains. There is not enough silver being mined to meet the demand from industry. The gap has to be filled somehow, and it's being filled by draining inventory. When that inventory hits zero, the system breaks permanently. There are analysts out there projecting silver at $300 per ounce. Others are saying $50 is the new floor. I'm not going to give you a specific price target because nobody actually knows. Anyone who tells you they know exactly where silver is going is either lying to you or lying to themselves. But what I can tell you is that the supply and demand fundamentals are the tightest they have been in decades, possibly ever. The ratio of paper contracts to physical metal has never been this extreme. The drain rate from the vaults has never been this severe. The industrial demand has never been this insatiable. Something has to give. So, what do you actually do with this information? How do you position yourself in the next 20 days before February 27th arrives? Step 1. Watch February 27th like a hawk. That's first notice day for the March contracts. Watch how many contracts stand for delivery. If that number exceeds 75 million ounces, things are going to get extremely interesting. COMEX will be facing a delivery demand that could drain its vaults in a matter of days. Step 2. Track the registered inventory at COMEX on a daily or weekly basis. The data is publicly available. If registered silver drops below 80 million ounces before first notice day, the math becomes impossible. They won't have enough metal to satisfy the demand. Something will have to break. Step 3. Watch the silver lease rate. We're currently at 8%. If that number climbs higher, to 10, 12, or 15%, it's the market screaming that physical silver is scarce. It's like watching the borrow fee on a heavily shorted stock. When that fee goes parabolic, you know you're approaching a breaking point. Our framework is simple. Verify what's actually in the vault.